Um, and that deficit is what, call it 300, 400 million ounces. I mean, it's huge. That there's a new battery, an EV battery that charges in 9 minutes and goes 900 kilometers, but it requires about a kilogram of silver. So you're talking about, for every battery, you're talking about 32 ounces. The physical exchange is trading far above, and I mean that premium is blown out to $7, $8. Now we have 100 contracts standing for delivery the first day, and by the end of the month, it's 200 or 300. So the buyers are coming in during the month and saying, "Okay, I'm buying the contract. I want the metal." All it would take is one big buyer or a consortium of big buyers to come in and say, "I want my metal," and it's completely game over because the metal does not exist to deliver. It would have been in silver and gold. Look at the price of silver on Friday. Was up what, $7.58, something like that. And you can see that because Shanghai, I mean, New York was down what, $7, $8, and Shanghai was barely down $3. And day after day after day, the U.S. is getting weaker because, I mean, we're paying we'll pay probably 1.5 trillion in interest this year, and add an additional at least $2 trillion to the debt pile. The outstanding debt with the gold that we say we have, you're talking close to $150,000 an ounce. That's where the price would have to go. But that's assuming we have 8,300 tons. And I personally assume that we do not have 8,300 tons and that gold has been going out the back door for years and years and years. 1956 was the last year there was an audit. You've got so many more paper contracts sold for every 1 real ounce that exists. It's a game of musical chairs with one chair, and you got 300 people walking around that chair. I think it's pretty obvious something has broken. I mean, you're watching silver move $3, $5, $8. Yesterday's move was from top to bottom was like $12. Now we've recovered more than half of that today. Something has broken. The volatility has exploded, and the problem with volatility is silver's a leveraged market. If silver fails to deliver, and I fully expect silver to fail to deliver in both New York and in London, but when it fails to deliver, that is going to affect all other derivatives because everything runs on trust. I 100% believe that this structural shift is it's permanent. It's what's going to be. It's the future. Paper contracts are not the future. Paper contracts are dying, and the same could be said for the dollar itself. The dollar is dying. You can just see it in the vaults. All three of them: LBMA, COMEX, and Shanghai. They've just been being drained on a daily basis of physical metal.
In this urgent interview, Bill Halter, Mr. Gold, details a critical inflection point in the silver market, declaring a structural supply deficit of 300 to 400 million ounces is now breaking the 50-year paper trading system. Explosive industrial demand from AI and new EV batteries is colliding with rapidly draining vaults in London, New York, and Shanghai. The market has entered a state of severe backwardation, where physical silver trades at a massive premium to futures paper, a sign investors want metal now and trust contracts less. Halter warns a failure to deliver is imminent, potentially within 30 to 90 days, as standing delivery requests grow monthly.
When you get the cash price above the futures price, that's backwardation, and that shows that investors don't want to wait 30 days, 60 days, 90 days for their metal. They want to pay for it today, and they want it today. Yeah, about $7 or $8, the cash market, the cash exchange is ahead of the two paper exchanges, COMEX and LBMA. That is blatant, outright backwardation. It tells you investors are not willing to wait for their metal. They're not willing to trust that they're going to get their metal. They want it now. How many different uses are there for that? You've got solar, you've got medicinal, you have technological, you have jewelry, you have just investors buying it. The silver that has been been produced over the last few thousand years largely has already been used. There's not any big stockpiles, whereas gold, there are some very, very large stockpiles, and I think larger stockpiles than are being let on. I think Russia and China both have well more gold than what they're letting on. When the fiat currencies truly break and zero out, gold and silver will be the absolute core of whatever comes forth after that. So no, we're still early. We're early in the game price wise. Time wise, I don't know because we could have a failure to deliver this month, next month, whatever. When it fails to deliver, then it's game on or it's game over actually. If I had nothing at all, I would start with silver because yeah, it's nice to hold a 1 ounce gold coin in your hand, but it's also probably nicer to hold 60 ounces of silver that you're going to be able to use when a system breakdown comes. The one sector that is still under heavy pressure is junk silver. And the reason being, back in the 1970s and 1980s, the only way for an American to buy silver really was buying junk pre 1965 dimes, quarters, and half dollars. Now, those people sat on losses for 40, 50 years, and a lot of that metal has come back. I mean, there's a ton of sellers, and what's happened is dealers, because they were getting flooded with metal, they backed away price wise, and as they backed away and made the discount larger and larger, then that metal was going to refineries to be refined into 99.9 silver, and they pocket the profit. But that's the pressure in the retail market is selling of junk silver, which is a great opportunity if you're looking to buy silver. Junk silver is now the cheapest form that you can buy, and hands down, it is the best form for an American to own. It's the smallest denomination, which will be best for barter. It can't be counterfeited because it can't be shiny coins. These are in people's pockets. They've got to be scruffy. Uh, it's U.S. Mint lineage coin, so it's something that came from the U.S. Mint. Let's see, we have smallest denomination, U.S. Mint lineage. Can't, oh, and it's totally readily recognizable.
This event would shatter trust across all derivative markets. He advises investors that it's not too late to allocate capital to precious metals, recommending junk silver, pre-1965 U.S. coins, as the cheapest, most practical, and barter-ready form to own. The discussion concludes with a stark warning about the Great Taking, where bank deposits and brokerage assets are legally lenders' assets, not yours, making physical metal held outside the system the only safe haven.
How much should I put into gold and silver? My standard answer, probably for the last 5 years or more now, is you put into metal whatever you don't want to lose because the rest is at risk. And I don't know if you followed the Great Taking or read about it, but that is 100% factual. It's not just precious metals. You're talking about trust. You know, gold is money. It's the only currency, gold and silver, the only currencies that you can trust. Everything else is freely printed. Everything else is fiat. So the shock waves will be one of trust, and the shock waves are not going to be held just to the precious metals markets, and it will probably create much, much higher interest rates in the U.S. because borrowing is done based on trust, and if trust is collapsing, then we'll finally have a risk premium for owning U.S. paper. We were the center of the universe for finance. We were the center of the universe for a lot of things. That's no longer the case. The COMEX could say, we're not going to accept buy orders and the price go to $3, but Shanghai goes over $100. What will happen is the rest of the world is now more powerful, if you will, than the U.S., where it used to be the U.S. was more powerful than the rest of the world. I mean, there's no way that they could outlaw buying on COMEX and expect the physical price to go down. This whole year was dominated by AI. You can't have AI without silver. Silver is part of so much of that application. That's going to also increase the demand. For years we saw uh, the retail market in the United States was a big buyer. The retail market is nothing now. The retail market uh, is not even a tailwind. This is institutional money. I mean, these are hedge funds, these are private family offices, and in some cases, sovereigns. I mean, look at Russia. They declared Russia. They declared silver a strategic metal, and they're buying it. Look at the imports into India, and I mean, those are official purchases. Yeah, there's obviously uh, reasons for buyers to lie. I bought more than I bought, or I bought less than I bought. It's hard to know, but the bottom line is we're seeing massive demand. We're watching inventories deplete, and at some point in time, there is a tipping point, and that tipping point will be a failure to deliver. Read The Great Taking. When you deposit money into a bank, you're no longer a depositor. You're legally classified as a lender. When you put money into a brokerage account and you buy stock, that stock does not go into your name. It goes into the broker's name for your benefit. But if the broker gets into trouble and they fail, guess what? Those assets are the broker's assets, not yours. So it's not government stealing the money. It's companies that go bankrupt using the current bankruptcy laws to steal your money. It's a game changer, but how long can they do it? Where the supply is going to come from? The supply is not there. The way to fix this is to raise the price massively to entice some people that have bought to sell. Because right now, anybody who bought physical metal has not been a seller. I mean, I guarantee you there was no big tranches of silver or gold that were sold yesterday. Physical metal. That was all paper. And actually, you can see it's all paper because the Federal Reserve lent what 17 billion on Thursday night, and then they lent another what was it 34, 35 billion over the weekend. So those shorts had margin calls. The Fed helped them meet the margin calls and gave them enough to pile more paper on. The only problem is they can't print silver. They can't print contracts that have silver attached to them to deliver. They can sell contracts all they want and depress the paper price, but that is not going to satisfy silver, which is actually used. I mean, if you try to barter with say, a 1 ounce buffalo or a bar or something like that, there's always going to be a question, is that real? But if you got a 1964 or earlier dime, quarter, half dollar, Americans know what they look like. And if the date is 64 or earlier, you know for a fact that's proof, it's authentication that it's 90% silver. I see no way that we're closing in on a top because the uses for silver are expanding. The supply is not expanding. We're already in a structural deficit. Uh, both gold and silver. Let's talk about leverage for a second. The carry trade was used to support financial markets for 30 plus 40 years. Uh, Leveraged capital has been used to support the equity and the debt markets. And it's also been used to suppress the gold and silver markets. So when credit breaks and there's margin calls, the margin calls on stocks and bonds will force selling, whereas the margin calls on gold and silver will force buying. It'll force buying from the cappers, the JP Morgans, the Bank Americas, the companies that are short and have been short silver. Their way to exit the trade is to buy, and that will create massive upside pressure on the metals.